Good day, and welcome to SNN Network Summer Virtual Event. Our next presenting company is Bitwise. It is now my pleasure to turn the floor over to your host, Matt Hogan, Chief Investor Officer of Bitwise Asset Manager. Sir, the floor is yours.
Hey, thanks so much. Thanks, everyone, for your patience this morning. We had a few technical difficulties on my side with our slides and with the viewer, so I apologize for getting started a few minutes late, but we'll wrap up by the half of the hour. My name is Matt Hogan. I'm the Chief Investment Officer here at Bitwise Asset Management. For those of you who don't know me, Bitwise is one of the world's largest and fastest growing crypto asset managers. We're best known in the space for having created and today running the world's largest crypto index fund. So if you think of the S&P 500 in equities or bond indexes in the bond space, we are the largest provider of crypto index funds in the world. We currently manage about $1.3 billion in assets. We've been in the market since late 2017, so we've been managing these funds for over 3.5 years now. I really just wanted to do 3 things today, which I'm going to do without slides. We're going to do this old school style with just my voice. And that's really dispel what I think are the 3 biggest myths around crypto. And I'll save some time at the Q&A so that you can ask me questions at the end. But I want to talk about first what crypto really is and what it isn't. Because although people have strong opinions about crypto and although it's covered in the mainstream media significantly, I think there's a generalized misunderstanding about what crypto is really all about. And I'm going to hope to arm you with the ability to describe what crypto, what blockchain, what Bitcoin really are, and why they matter to your friends, your families, your advisors, your clients. Then I want to talk about why there's more than one crypto asset. I think people have this view of different crypto assets like Bitcoin and Ethereum being essentially the same and competing for the same use cases, being fungible. In other words, you can replace one with the other. And I want to talk about how they actually differ and why it may be interesting to own more than just one crypto asset, why Bitcoin alone may not be enough. And then I want to dispel one quick rumor around crypto's role in a portfolio. And if I can do those 3 things, I think we'll succeed in bringing everyone on the call to a strong fundamental understanding of what this market is. And again, I think this is not generally well understood. Let's start with the first one, what crypto is and why it really matters. I think a lot of people have a fundamental misunderstanding about what crypto and blockchain is and why it matters. And that fundamental misunderstanding is driven by the fact that people think of crypto with the word cryptocurrency. In the early days of crypto, everyone referred to Bitcoin and other assets as cryptocurrencies. And so the mental model we have in our heads is that we're going to use Bitcoin in the same way that we use dollars. And when viewed from that perspective, crypto doesn't look very good. I'm the CIO of one of the world's largest crypto asset managers. I'm in the space 24/7, 365. I live in the San Francisco Bay Area, a very tech-forward locale. And yet, despite all that, I don't use Bitcoin in the same way that I use dollars. When I go out to buy my morning coffee after this call, I'm not going to pay for that morning coffee in Bitcoin. I'm going to pay for it in dollars. People don't use Bitcoin. They don't use other cryptocurrencies in the way they use traditional currencies because it's not accepted at many retailers and because the price is very volatile. Expressed in US dollars, the price of coffee can go up or down 10, 20, 30, 40, 50% over a series of months. So viewed as a currency, crypto doesn't yet measure up. And I think that is the reason why a lot of traditional financial professionals dismiss crypto as tulip bulbs or suggest that it will never amount to anything. And I want to reframe your view of it. Stop thinking of crypto as a currency and start thinking of it as a technology. And it's a technology that allows money to move over the internet and exist on the internet for the first time in history. And I'll give you one very simple example of this, and then expand out to what that means for the future. Today's Wednesday, and if one of us wanted to go send a bank wire to London, we would travel to the bank. If we got there after banker's hours today, the wire wouldn't actually go out until tomorrow, and it would take 2 business days, and it wouldn't arrive in London until Monday. In other words, if we missed banker's hours today, the fastest we could get money to London from our house is in 5 days. And that's just the way the traditional financial system works. If I wrote you a check and you deposited it at your bank, it would take 3 or 4 days before you could withdraw that money. If I go onto bill pay and send a bill to somebody, it may take 5 to 10 days before it hits my account. Money is one of the slowest moving things in today's society. By comparison, if I were to go on the Bitcoin blockchain right now, I could move $1 billion to anyone in the world and have it settle in 10 minutes for a fee of a couple of dollars. Think about that for a second. If I were to walk in the offices of Bank of America, one of the largest banks in the world with 250,000 employees and offices in 38 countries, the fastest they could move $10,000 to London is in 2 business days and maybe 4 or 5 calendar days. By comparison, you have this offline network or this online network with no employees, no offices, no internal balance sheet, this Bitcoin thing that people are skeptical of. And they can move $1 billion anywhere in the world and have it settle in 10 minutes. It is an extraordinarily efficient technology for moving not just cash, but any financial good around the world. Now, when I say that, I know what many of you are thinking because I've given this presentation before, and you're thinking, Matt, I can already do that. I have apps on my phone like PayPal, like Venmo, that allow me to move money to my friends instantaneously. And that's very true. I'm sure most of you on this call have used PayPal to send $20 to someone on eBay or used Venmo to split a bill with your friends when you went out to dinner. Venmo is one of the most popular apps in the world, downloaded by 200 million plus Americans. And the reason we all love it is it allows us to move money to our friends and have it get there instantly and easily. That's a service that people are interested in and want, and 200 million have put that service onto their phone. But what very few people think about is why Venmo can move money so quickly when traditional banks, despite their heft and size, take so long. And the answer is not because Venmo is a tech-savvy, cool app. The reason actually has to do with database architecture. Venmo, or PayPal, well, let's take Venmo, is a walled garden. Inside of the walls of Venmo, you can only send money to another Venmo client. And Venmo controls every single transaction. So if I say I want to send you $100, Venmo can look, make sure I have $100 in my account. It knows that I haven't tried to send that money to anyone else. And it can transfer that money to your account as quickly as you can change one line in an Excel document. By comparison, if I were to write you a check from my bank and you were to deposit it at your bank won't let you have the money until it checks with my bank to make sure my account's in good standing, that I have $100 in my account, that I haven't written 10 checks on that account. And only after going through those checks and processes will you be able to withdraw the money on the other side. In other words, one database is fast, and 2 databases is slow. And the reason the traditional financial system is so slow, whether it's moving cash or bills or stocks or any other asset, is because it exists as thousands of databases. And that process of those databases speaking to each other and coming into alignment takes a lot of time. Now, I raise this because the single best way to understand what a blockchain is and why it matters is to think about that Venmo example. Venmo is able to move $10 and have it settle instantly because it's a single database. All a blockchain is, all the Bitcoin blockchain was it was the first database ever created, that's available everywhere, that everyone in the world can see, that everyone agrees is true, but which no one single party needs to maintain. So it's like Venmo in that it's one database available everywhere in the world that everyone agrees is updated and fair and updated in real time, but without Venmo sitting on top of it. This is actually a giant computer science breakthrough. People had worked for 30 years to create such a database. And the Bitcoin blockchain and all subsequent blockchains that followed were the first one that were able to break through and design this. Now, why does that matter? Well, it matters for three reasons. It allows us to do three things that we've never been able to do before. The first thing is we can move any financial good anywhere in the world and have it settle in a matter of minutes, as opposed to taking multiple days. And this is a huge breakthrough. We can also do it with extremely low cost, because the process in the traditional financial system of checking and reconciling is what drives up the costs of moving money around the world. It's why Visa is able to charge a multiple percent fee. It's why international remittances cost 8% or more in some cases, and it's why bank wires cost 1 to 4% and take multiple days to process. All of that can go away once we have crypto-enabled blockchains in place. But that's actually not the most interesting thing that crypto does. Once you have money that can move at the speed of the internet, you can actually program it the way you would program software. And it turns out that a lot of what the financial industry does and a lot of what it charges fees for is really just processing if-then statements. If you think about when you bought your house, you probably had an escrow agent. And that escrow agent sat in the middle of your transaction, waited until you sent them the money to buy the house, and the person who owned the house sent them the deed. And then once those conditions were realized, it crossed the transaction. They probably charged you a few $100 to $1,000 for that service. Well, guess what? That's really just an if-then statement. If person A uploads the money and person B uploads the deed, cross the transaction. Once you have money that exists on the internet, you can process that with software rather than hiring a high-priced lawyer to sit in the middle. And it turns out that that's true of a lot of what finance does today. Things like stock trading, lending, even asset management. A lot of that can be automated and replaced by software. And there's a huge part of crypto, which you've probably heard about, called decentralized finance, that's doing exactly that. That's disrupting traditional financial services by utilizing the ability for money to move on the internet, which is what crypto allows. And that's not even the most interesting thing. Perhaps the most interesting thing that crypto allows is it, for the first time ever, creates digital property rights. I'm sure you've heard about NFTs. They've been in the news recently. I'm sure you saw that someone paid $70 million for a piece of digital artwork. I'm sure you've heard the words, Bitcoin is digital gold. The reason we have digital artwork today, and we didn't in the past, the reason people are collecting NBA Top Shots today, and they weren't in the past, is because blockchains enable the creation of digital property rights for the first time ever, and here's why. One issue with digital goods is that they're just strings of letters and numbers. If you think about my bank account at Wells Fargo, it's a string of 10 numbers. And the only reason I own that string of numbers is because Wells Fargo maintains a database that says Matt owns these numbers. Otherwise, you could create an infinite number of copies of the 10 numbers that make up my bank account just by pressing Control-C, Control-V on your keyboard. So historically, in order to own a digital good, you needed a centralized party that maintained a database that said, you own this. But with crypto-enabled blockchains, with a database that's available everywhere in the world that everyone agrees is true, but no single party controls, well, all of a sudden you can own a digital good and everyone in the world agrees that you own it. In the same way as if you had a Picasso on your wall, everyone in the world would agree that you own that Picasso. And I know people look at the returns of crypto assets and they shake their head. You know, crypto is the best performing asset class in the world this year. It's up over 60%, outperforming stocks, bonds, gold, oil, real estate, anything you look at. And it was the best performing asset class in the world last year, up over 300%, dramatically outperforming all those other assets. And it was the best performing asset class in the world in 2019. It's been the best performing asset class in the world over the last 1, 3, 5, and 10 years. And it's been incredibly resilient. People like to talk about crypto's volatility as if it were a bad thing. It can be tough to stomach. But the fact that Bitcoin and crypto has rebounded from 70% drawdowns is a signal that there's something important there. And people look at those returns and they scratch their heads and they wonder how this fake internet unicorn money that fell from the sky can now be a $2 trillion market, and it crossed the $2 trillion market cap today. And the reason is because it's not a currency. It's a technology that allows money to move over the internet, that allows you to program money like software, and that allows you to have digital property rights for the first time ever. And those are some of the most fundamental new ideas that I've encountered in my career. If you think back over the history of the internet, since its creation in 1971, the history of the internet is us figuring out new things to do with it, and those new things disrupting markets. As an example, in 1982, we figured out how to send text over the internet. Before that, all you could send was files in something called Simple Mail Transmission Protocol. And that allowed us to create email and disrupted the Postal Service. In 1989, someone figured out a Hypertext transfer protocol, which you probably better know as HTTP, which is what allowed us to send linked text over the internet, create the World Wide Web. And that disrupted all of media and advertising. In 1995, someone figured out how to send voice over the internet. Now that disrupted all of voice phones. In 1994, someone figured out how you put credit card information into the internet securely using something called Secure Socket Layers Protocol. Before 1994, there are all these warnings: never put credit card information into the internet. We figured out how to do that in 1994, and guess what? Amazon was founded in July of that year. In 2009, we figured out how to stream video over the internet, and now we all use Hulu and we've cut the cord and cable. What crypto, Bitcoin, and blockchain is the ability to send money over the internet. And my bet is that that will allow the internet to disrupt money and finance in the same way that it's disrupted video and messaging and telephony and commerce and media and advertising and the mail. And the fun thing about it, and the reason crypto is attracting so much venture capital investment and so much talent right now, is that money and finance is the largest single market that crypto's ever gone after. Now, I do want to spend just a few minutes on why there's more than one crypto asset, and because I think that's something that people don't generally understand as well. They look at different crypto assets like Bitcoin, Ethereum, et cetera, and they imagine that only one will be needed because it's the internet of money and the internet is a global thing. So why do we need the equivalent of the dollar and the yen and the pound and the euro in the age of cryptocurrencies? We only need one. And you probably know what I'm going to say, which is that that view of crypto as a currency is the wrong view, and you again have to address it like a technology. I like to think of different software companies. If you think about companies like Microsoft and Slack and Oracle and Salesforce, they're all software companies built on a fundamental technology rail, but they're all optimized to do different things. We use Microsoft for word processing and Excel. We use Slack for our internal communications. We use Salesforce to track our customers. The same thing is true of crypto. If you look at Bitcoin and you look at Ethereum and you look at Solana and you look at Chainlink and you look at Uniswap and other large cap crypto assets, they're all technologies that are optimized to do different things. I'll just dwell for a second on Bitcoin versus Ethereum because they're the two largest assets to give you the view. Bitcoin was the first crypto asset. The underlying Bitcoin blockchain that supports that asset was the first blockchain. And like many first technologies, it's pretty basic. In fact, you can only program the Bitcoin blockchain to do a few things. You can program it to send or receive Bitcoin. You can program it to hold Bitcoin. You can do some very simple trust or escrow-like arrangements, and that's it. It's more like a calculator than it is like a computer. By comparison, the Ethereum blockchain was developed in part in response to Bitcoin. It looked at Bitcoin and said, being able to send $1 billion anywhere in the world is pretty cool, but what if we could program you like we could program traditional computers? What if we could program you to serve as a lending agent? What if we could program you to replace investment bankers in the capital creation process? What if we could program you to serve as an exchange? And that's what people are doing on Ethereum. Now, you may be wondering why Ethereum is not as valuable as Bitcoin. Bitcoin has by far the largest market cap, and the reason is that it depends on the use case. What people are using Bitcoin for is as digital gold, a way to escape inflation or potential inflation in traditional fiat currencies. And from a digital gold perspective, all that you care about is that the underlying blockchain is safe and secure. And in cybersecurity, having a limited programming interface, being able to do only a few things, actually makes your technology more secure. If you want to make it concrete, when Bitcoin launched, it only had about 300 lines of code. When Ethereum launched, which can do anything, it had over 1 million lines of code. It's much more likely to find a bug in 1 million lines of code than it is in 300. So Bitcoin is a more secure, distributed blockchain than Ethereum, and therefore perfect for the digital gold case. But Ethereum is more performant than Bitcoin. You can program it to do anything. It's more flexible. It's more useful. And so all the decentralized finance activity is being built on Ethereum right now and not on Bitcoin. That market is very exciting, but it's also newer than the digital gold market that Bitcoin is going after. And as you go down the stack of different assets, what you'll find is that different crypto assets are optimized for different goods, different uses, in the same way that different software companies are optimized for different uses. Again, the internet disrupting money and finance is one of the biggest stories I've ever encountered. And it's not surprising that it will take multiple different assets and multiple different blockchains to fill all of those use cases. One of the reasons Bitwise is focused on crypto index funds as opposed to providing exposure to individual crypto assets as the main way we work with investors to gain exposure to this space is because we think index-based strategies capture the full scale of disruption taking place in crypto without having to pick and choose between any individual asset and find the right one for you. Now I have 2 minutes left. I'm just going to wrap up with one broad-based thought. A lot of people ask me questions about how much should people allocate to crypto. People ask me questions about when to allocate to crypto. And I'll just suggest to you that we've been studying those questions extensively at Bitwise. If you go to our website, bitwiseinvestments.com, and go to the resources page, we have a new white paper that talks about the role of crypto in a professional portfolio. And it uses fairly sophisticated analysis to analyze on a historical basis the impact of different size allocations to crypto and makes sort of findings around the best ways to rebalance and incorporate crypto into a portfolio. With that, I really appreciate all your time today. Thank you all for listening so much, and have a great rest of your day. Again, if you want to learn more about Bitwise, bitwiseinvestments.com, or follow me on Twitter at @Matt_Hogan. Thanks so much. Talk to you soon.
Ladies and gentlemen, this does conclude Bitwise presentation. Thank you for joining. You may now disconnect your lines.